Welcome to the deep dive. We're here to take complex ideas and, well, make them clear, give you that shortcut to really being well informed. Today, we're tackling something that sounds maybe a bit intimidating, but is absolutely essential if you're serious about building long term wealth: fundamental analysis. Yeah, our mission today is simple: give you the tools, the insights to understand a business from the inside out. We've gone through some really comprehensive guides on fundamental analysis, and we're going to pull out the absolute must-know stuff for you, help you cut through the noise, spot those companies truly set up for growth. Okay, so let's just dive right in. What is fundamental analysis exactly? And why should you care, if you're thinking long-term about your money?
Right. So fundamental analysis, or FA as you'll hear it called, it's really a holistic way to look at a business. It's about studying everything about it. And it's absolutely key for long-term investing. We're talking 3-5 years, often much longer. The core idea is to ignore that daily stock price chatter, that noise, and focus instead on how the underlying business is actually performing. And what's really powerful here, well, over the long haul, fundamentally strong companies tend to appreciate. They create wealth. That's the goal.
And we see that, don't we, in the market data? You think about some of those big names, maybe a top IT firm, a major car maker, a big consumer goods company. These kinds of businesses, they've often given, compounded annual growth returns, KAGRs of over 20% for more than 10 years. That actually means your money could double in about 3.5 years. It's quite something.
Exactly. And you contrast that with, well, what some call wealth destructors. Companies that just haven't performed, maybe a struggling energy company or, a biotech that didn't pan out. The real skill then is learning how to separate those truly investment-grade companies from, well, let's be honest, the junk.
Okay, but does this mean you need a finance degree or be an accountant?
Great question. And no, absolutely not. That's a common misconception we should bust right now. You can be a fundamental analyst. Just need some pretty basic skills. Can you understand a financial statement? Get the gist of an industry? Do simple arithmetic? That's really the foundation. It's more logic than high finance.
Now, lots of folks get into technical analysis, right, for quicker trades, shorter term gains. If that works for them, why bother with all this deep diving FA stuff?
Yeah, and that brings up a really important point. Technical analysis, TA, it's excellent for timing, short-term entry, exit points. It helps you make the most of those quick price swings.
So it has its place.
Definitely. But here's the key difference. TA isn't really designed for long-term wealth creation. That kind of wealth, the significant compounding kind, typically comes from intelligent, patient, long-term investing based on fundamentals. But, and this is crucial, they aren't mutually exclusive. They really should coexist. Think about, say, Eicher Motors in India. From maybe 2006 to 2010, the stock didn't do much fundamentally. TA might have offered some trading chances then. But the real move, the massive wealth creation for FA investors, that started around 2010 when the business fundamentals truly took off.
Which leads nicely into managing your money, right? This idea of a core satellite strategy.
Exactly. It's a smart way to think about allocation. Let's say you have, $500,000 to invest. You might put, say, 60% your core into these long-term FA-driven investments. You're aiming for maybe 12-15% compounded growth annually. Steady eddies, ideally.
Okay, the stable base.
Right, and the other 40%, that's your satellite. You can use that for more active, short-term trading, maybe using TA. You might aim for, say, 10-12% absolute return per year there. It's about blending the two approaches.
And the tools needed for FA, are they complex, expensive?
Surprisingly, no. Many are completely free. Company annual reports, essential reading, industry data, often available online, setting up news alerts, like Google Alerts for companies or sectors you follow, and honestly, a basic spreadsheet program like MS Excel. Even the big institutional research firms, fundamentally, they aim to keep it simple and logical. It's not about needless complexity.
Okay, so beyond the data, the tools, there's mindset, isn't there? When you enter the market, how do you see yourself? Are you speculating, trading, investing?
That's a critical distinction. Let's paint a picture. Imagine there's a big central bank announcement coming up, say, on interest rates, during a time when rates have been rising. First, you have Sunil. He's a speculator. He's absolutely certain rates are too high, got to come down. He reads a few blogs, finds opinions confirming his gut feeling.
Affirmation bias.
Precisely. And he makes a big, risky bet, maybe buying call options. It's based on blind faith, really, trying to predict the unpredictable.
Okay. And who's next?
Next is Tarun, the trader. Tarun knows predicting the central bank is, well, a fool's game. But he sees volatility as high before the announcement. Option prices are inflated. His strategy, maybe based on past data, suggests volatility will crash after the news is out. So he sells options, planning to close the trade quickly. He has a plan, a system, not just a hunch.
Makes sense. Calculated risk.
Right. And finally, there's Girish, the investor. Girish has a portfolio, maybe a dozen stocks, held for years. He monitors the economy, sure, but this specific announcement is just noise to him, short-term market fluctuations.
A blip on the long-term radar.
Exactly. He has the luxury of time, patience. In fact, if the market overreacts and prices dip, he might see it as a buying opportunity. For Girish, his decision to actually do nothing in response to the noise is a market action, a very deliberate one.
That's powerful. And what really stands out there is Girish's long-term view, allowing him to harness, well, the luxury of time, which brings us right to compounding, doesn't it?
Absolutely. Compounding it's the engine of long-term growth. It's simply your money earning returns, and then those returns earning more returns. Take 100 units of currency, invest it at 20% a year. Now, it takes about 6 years for that 100 to become 300.
Okay.
But here's the magic. It only takes 4 more years for that 300 to more than double again to reach almost 620.
Wow, it accelerates.
Massively. The longer you stay invested, the harder and faster your money works for you. That's why Girish stays put. He's letting time and compounding do the heavy lifting.
So the question becomes, does investing actually work? I mean, fundamentally.
Think of it like planting a sapling. Give it the right conditions, water, soil, sunlight, and it will grow into a tree. It's almost inevitable, barring disaster. Same with a good business. Healthy sales, solid profit margins, good products, ethical leadership. Over time, its value should appreciate.
Even if the stock price bounces around day to day.
Exactly. The price might lag, it might get ahead of itself sometimes, but eventually, value tends to follow performance. Your job, as that investor, is to develop the stomach, the appetite, to handle that short-term volatility without panicking.
Right. And what defines that good business? You mentioned investable grade attributes.
Yes. These are the characteristics that separate the strong companies from the weak, and they generally fall into 2 buckets. Qualitative, the non-numeric stuff, and quantitative, the numbers.
Okay, let's dig into the qualitative side first. This sounds really interesting. It's not just about the spreadsheets.
Not at all. Qualitative aspects are critical. They're about the character, the integrity, the feel of the business and its leadership. We're looking at things like what's the background of the management team or the experience, ethics.
Any history of scams, bribery, that sort of thing.
Absolutely. How transparent is their corporate governance? How do they treat minority shareholders, people like you who might own a small slice? Are there weird share transactions happening behind the scenes?
Right.
What about related party transactions? Is the company doing deals that seem to unfairly benefit insiders or connected companies?
Like paying too much for services from a company owned by the promoter's family?
Exactly that kind of thing.
Yeah.
Promoter salaries, are they excessive? Is there unusual trading activity suggesting market manipulation? Who are the other major shareholders? Any concerning political ties, even the promoter's lifestyle, if it seems wildly out of sync with the business's performance, can be a yellow flag.
So these are the red flags to watch out for.
Precisely. A company might boast amazing profit margins, but if it's playing fast and loose with related parties or ethics, the market will figure it out eventually, and it usually punishes that behavior severely. Trust is everything here.
Okay, that makes sense. So after the qualitative, we have the quantitative aspects, the numbers.
Right, the hard data. This is where we crunch the numbers from the financial statements. We look at profitability, margins, earnings, expenses, operational efficiency, how much pricing power do they have, how do they manage taxes, what's their dividend policy, crucially, cash flow generation. Debt levels, how much do they owe? How well do they manage their working capital? Are their assets growing? What investments are they making? And then we use various financial ratios to compare and analyze these things.
And these metrics might differ by industry, right?
Absolutely. What's important for a retailer like same-store sales or inventory turnover might be less relevant for an oil and gas explorer, where you'd look at reserves or exploration success rates. Context is key.
So where do we find all this info? The qualitative clues, the quantitative data?
Your number one go-to should always be the company's official annual report.
Okay.
It's the yearly publication for shareholders, audited by independent professionals. Make it your default source.
Not just relying on, say, financial websites or news summaries.
Those can be useful for quick checks, but they sometimes summarize or categorize things differently, which can unintentionally misrepresent the data. The annual report is the ground truth.
Okay, so you crack open this potentially huge annual report. What are you looking for first?
Well, you'll often see financial highlights near the front. That's a quick summary, fine for a glance, but don't stop there. It's just the surface. Then look for the management statement or chairman's message. This is revealing. Does management sound realistic? Are they open about challenges, or is it all hype? I once decided against investing purely because the chairman projected like 10% revenue growth when historically they'd only ever managed 4 or 5%. It just lacked credibility.
Interesting. What else is critical?
The Management Discussion and Analysis, MD&A section. This is arguably one of the most important parts. It discusses the big picture macro trends, economic outlook, then industry trends, threats, opportunities, the company's competitive advantages, and finally, how the company actually performed across its different segments, plus their plans for the future. It's gold.
Any other sections?
Depending on the industry, things like HR reports for labor-intensive businesses or R&D reports for tech or pharma can be quite insightful too.
Okay. Now, the core of the report, financially speaking, are those 3 statements, right? The P&L, balance sheet, cash flow.
Exactly. And remember, our role here, as fundamental analysts, we're users of these statements, not the accountants who prepare them. Our skill is in interpretation.
Got it. So let's break down the profit and loss statement, the P&L or income statement. What's it telling us?
The P&L reports financial performance over a period of time, typically a quarter or a full year. It starts with the top line, revenue. That's sales of products, services, other core operating revenues. Now, watch out for a line item called other income. This is income from non-core stuff like interest earned on investments. Ideally, this should be small.
Why is that a potential issue?
If a big chunk of the company's profit comes from other income, it might mean the main business isn't actually that profitable. It's a potential red flag about the core operations health.
Okay. Then come expenses.
Right. Things like cost of materials consumed, often the biggest chunk, purchases of stock and trade. Then there's change in inventories. This one can be a bit confusing. If it's negative, it means the company produced more goods than it sold during the period. The cost of those unsold goods stays on the balance sheet as inventory, reducing the expense shown on the P&L for that period.
Ah, okay. It defers that cost recognition.
Exactly. Then you have employee benefit expense, finance cost, interest on debt, and depreciation and amortization. Depreciation spreads the cost of tangible assets, like machines, over their useful life. Amortization does the same for intangible assets, like patents.
Now, you mentioned depreciation isn't actual cash leaving the bank, so how do we track the real cash?
Hold that thought. That's precisely what the cash flow statement helps us unravel. We'll get there.
Okay, teaser noted. So after expenses.
You get profit before tax, PBT. That's total revenues minus total operating expenses, adjusted for any unusual one-off exceptional items. Subtract taxes, and you arrive at the famous bottom line, net profit after tax, BAT. And finally, a number analysts watch very closely, earnings per share. EPS. That's a PAT divided by the total number of outstanding shares. It shows profitability on a per-share basis. A sacred number, really. Got it. P&L performance over time. Now, the balance sheet or statement of financial position. Right. The balance sheet is different. It's a snapshot at a specific point in time. Think of it as the company's cumulative financial condition from day one up to that date. And it's built on that fundamental equation. Assets, liabilities, plus shareholders' equity. It must balance.
Okay, assets first. What are they?
Assets are resources the company controls that are expected to provide future economic benefit. They're split into current assets, things expected to be converted to cash within about a year, like inventory, accounts receivable, money owed by customers, and actual cash. And non-current assets, long-term stuff, property, plant, equipment, often called fixed assets, long-term investments.
Then liabilities, the obligations.
Yep. Current liabilities, debts due within a year, short-term borrowings, accounts payable, money owed to suppliers. Non-current liabilities, obligations due further out than a year, long-term loans, deferred tax liabilities.
And the last piece of the equation, shareholders' equity or funds, why is that listed on the liability side? Feels counterintuitive.
It's from the company's perspective. The company, as a separate legal entity, owes that value back to its owners, the shareholders. It includes the initial share capital invested and, crucially, the reserves and surplus. This is where the accumulated PPT from the P&L goes, and it's the pot from which dividends are usually paid.
Can we zoom in on fixed assets for a second? Sometimes you see terms like gross block, net block.
Sure. Gross block is the original purchase cost of all fixed assets. Accumulated depreciation is the total depreciation charged against those assets over their lifetime so far. Net block is simply gross block minus accumulated depreciation. It's the asset's current book value on the balance sheet. You might also see CWIP capital work in progress for assets still being built, like a factory under construction, and similar things for intangible assets under development.
Okay, so it
Yeah.
seems clear the P&L and balance sheet are deeply connected, right? They aren't separate documents in reality.
Absolutely inseparable. Revenue on the P&L impacts cash or receivables on the balance sheet. Expenses impact payables or inventory. Depreciation on the P&L reduces asset values on the balance sheet. Finance costs on the P&L relate to debt on the balance sheet. And most directly, that P from the P&L flows right into reserves and surplus within shareholders' equity on the balance sheet. They constantly update each other.
All right, this is making sense now. You teased it earlier. The third statement, the truth teller, the cash flow statement.
Yes. This is where it gets really insightful. The cash flow statement shows how much cash actually came into and went out of the company. Profit is an accounting concept. Cash is reality.
Give us that laptop example again.
Right. Your business sells 500,000 worth of laptops, so your P&L shows 500,000 revenue. Looks good. But if, say, half were sold on credit, customers haven't paid yet, you only receive 250,000 in actual cash. If you had a 400,000 loan payment due that month, your healthy revenue figure hides a serious cash problem. The cash flow statement reveals that difference. It tracks the actual flow of cash.
So how does it break down this cash movement?
It categorizes all cash movements into 3 core activities that every legitimate business undertakes. Operating activities, OA. Cash flow from the day-to-day running of the main business. Selling goods, providing services, paying suppliers, paying employees. This is the engine room. You want this to be positive and strong. Investing activities, IA. Cash used for or generated from investments for the future. Buying or selling long-term assets like property, plant, equipment, PP&E, or investing in other companies. Often a cash outflow for growing companies. Financing activities, FA. Cash flow related to how the company's funded, raising money through debt or issuing shares, repaying debt, paying dividends.
Okay, OA, IAFA. And how do changes in assets and liabilities affect cash?
Generally think of it like this. When a liability increases, like taking out a loan, cash usually increases. When a liability decreases, paying back a loan, cash decreases. Conversely, when an asset increases, buying equipment, inventory piling up, cash usually decreases. When an asset decreases, selling old equipment, collecting from customers, cash increases. It shows the push and pull on the company's cash balance.
Let's apply that to our battery company example, ARBL. How did their cash flow look in that FY14 snapshot?
Okay, for Myra Raja Batteries Limited, ARBL in FY14, cash flow from operations, OA, was positive, around 279 crore rupees. Good sign, core business generated cash. Cash flow from investing, IA, was negative, about negative 345 crore. This makes sense. They were likely investing heavily in new capacity, buying PP&E for future growth. Healthy outflow, usually. Cash flow from financing FA was also negative, around negative 53 crore, mostly due to paying out dividends to shareholders. You sum those 3 up, and you get the net change in cash for the year. It tells the story of where the cash came from and where it went.
And the connection back to the balance sheet, how does it tie in?
Beautifully. The final number on the cash flow statement, the ending cash balance for the period, is exactly the number you'll find listed under cash and cash equivalents in the current assets section of the balance sheet for that same date.
Ah, so it reconciles perfectly.
Perfectly. All 3 statements, P&L, balance sheet, cash flow, are locked together. They provide a complete, interconnected picture of the company's financial health and activities.
Fantastic. Okay, so we know how to read the statements now, but how do we, extract the real insights, make sense of all those numbers?
Ratios, right?
Exactly. Financial ratios are the analytical tools. Think of them as lenses, like Benjamin Graham used, to compare, contrast, and evaluate performance.
But there's a catch, isn't there? You can't just look at one ratio in isolation.
Absolutely not. A single ratio is, well, almost meaningless. It's mute, as the source material puts it. It only comes alive when you compare it, either against the company's own history, see the trend over 3, 5, 10 years, or against its direct competitors in the same industry. And always keep in mind, different companies might use slightly different accounting policies, which can affect comparability. Need to be aware of that.
Got it. So what are the main categories of ratios we should look at?
We generally group them into 4 key areas: profitability, leverage debt, operating efficiency, and valuation, market price. Okay, let's start with profitability ratios. How good are they at making money?
Right. First up, EBITDA margin. That's earnings before interest, tax, depreciation, and amortization divided by revenue. It shows how efficiently management is running the core operations before financing decisions and accounting charges like depreciation kick in. For ARBL, we saw their EBITDA margin was consistently around 15% and trending upwards between 2011 and 2014. That shows really solid operating efficiency.
Then overall profitability.
That's the PAT margin, profit after tax, divided by revenue. It's the bottom line profitability. ARBL's was also increasing nicely in that period, showing strong overall performance.
What about returns to shareholders, return on equity, ROE?
Yes, ROE, PAT divided by shareholders' equity, is crucial. It measures how much profit the company generates for every unit of equity invested by its owners. Higher is generally better. Personally, I like to see ROE consistently above, say, 18%.
You mentioned a potential trap here. High ROE isn't always what it seems.
Exactly. This is where it gets really interesting. A company can boost its ROE simply by taking on a lot of debt, leverage. More debt means less equity in the denominator, which mathematically inflates ROE.
So it looks good, but it's risky.
Very risky. That's why the DuPont model is so powerful. It breaks ROE down into its components. Net profit margin, how profitable are sales, asset turnover, how efficiently are assets used to generate sales, and financial leverage, how much debt is supporting the assets. Using that Vishal's Pizza example again, if he borrows heavily to buy more ovens, his ROE might spike. But DuPont shows it's driven by leverage, not necessarily better pizza margins or efficiency.
So DuPont reveals the quality of the ROE.
Precisely.
Yeah.
ARBL's ROE was around 26% back then, which is fantastic. And the DuPont analysis would confirm it wasn't primarily driven by excessive debt. That's what you want to see.
Any other key profitability ratios?
Return on assets, ROA, measures profit relative to total assets, showing overall asset efficiency. And return on capital employed, ROCE, looks at profitability relative to all capital used, equity plus debt, giving a broader picture of management's effectiveness with the total funds at their disposal.
Okay, moving on to leverage ratios. Assessing debt and financial risk. You used Jane Irrigation, JISL, as an example of high debt here.
Yes, just for illustration. Let's look at a few key leverage ratios using a hypothetical high-debt company. Interest coverage ratio, EBIT divided by interest expense. How easily can the company cover its interest payments from its operating profit? If JISL's was, say, 1.2x, that means they only earn 1.2 rupees for every 1 rupee of interest owed. That's cutting it very fine. A low number indicates high risk.
What about debt versus equity?
The debt-to-equity ratio, total debt divided by total equity. If JISL's was 1.69, it means they have significantly more debt than equity funding the business, higher leverage. Debt-to-asset ratio shows what percentage of the company's assets are financed by debt. If it's 45% for JISL, nearly half their assets rely on borrowed money. And the financial leverage ratio, total assets divided by total equity. If JISL's is 3.68, it means for every 1 rupee of equity, they have 3.68 rupees of assets, implying the rest is funded by debt. The higher this number, generally, the more cautious you need to be.
Got it. Risk assessment is key there. Next up, operating ratios, measuring efficiency.
Right, also called activity or management ratios. How well are they managing day-to-day operations and assets? Fixed assets turnover, revenue divided by fixed assets. How much revenue do they generate from their plant and machinery? For ARBL, it was around 5.6 times, pretty good for a manufacturing company. Shows effective use of those big investments. Working capital turnover, revenue divided by working capital. How much revenue per unit of working capital? Current assets minus current liabilities. ARBL's 5.1 times suggested good efficiency in managing short-term assets and liabilities.
Okay, what about inventory and receivables? How fast do they turn those into cash?
Inventory turnover ratio tells you how many times they sell through their inventory each year. ARBL was about 7.8 times. The related inventory number of days shows this took about 47 days on average.
Now, is higher turnover always better here?
Usually, yes, it means efficiency. But here's an important question to ask yourself. Could extremely high turnover mask a problem? Like maybe they can't produce enough to meet demand or struggle to get raw materials. It needs context. A red flag potentially hiding in a good number.
Interesting nuance. And collecting cash from customers.
That's accounts receivable turnover. ARDL's 8.2 times a year meant they collected receivables quite quickly. The days sales outstanding, DSO, was about 45 days, indicating efficient collection processes. You don't want cash tied up too long with customers.
Makes sense. Okay, final category, valuation ratios. How does the market price the stock relative to its fundamentals?
This is where we connect the business analysis to the stock price itself. Price to sales, PS ratio, market cap divided by total revenue, or price per share, so sales per share. ARBL was maybe around 3.2 times. A higher PS might be okay if profit margins are also very high. Price to book value, PBV ratio, market cap, book value of equity. How much is the market paying relative to the company's net worth on paper? ARBL was trading at maybe 8.3 times its book value.
And the big one, price to earnings, PE ratio.
The most famous, yes. Stock price divided by earnings per share, EPS. ARBL was around 30, 31 times earnings back then. Key points on PE. It tells you how many years of current earnings it would take for the company to earn back its stock price. It indicates market expectations. High PE often means high growth expectations.
But earnings can be managed, right?
They absolutely can. You need to check the quality of those earnings, look at accounting policies, especially depreciation. Do earnings align with cash flow and sales growth? A high PE needs justification. Personally, I get cautious when PE ratios go much beyond 25 or 30, no matter how good the story sounds. Requires extraordinary growth to justify.
And you can look at the whole market's valuation, too, like the Nifty 50 index.
Yes, looking at the PE or PB of the overall market index gives you context. Historically, Indian indices might average around 16 by 20x PE. When the market PE gets above, say, 22x, it suggests general market frothiness. Below 16x might indicate the market is broadly undervalued, provides a backdrop.
Okay, wow, that's a lot of analysis. So after going through all this, understanding the business, crunching the numbers, checking the ratios, how do you actually decide this investment due diligence process?
Right. It's about bringing it all together in a structured way. Think of those investable grade attributes we talked about: quality management, strong financials, good growth as items on your personal checklist. You need a process.
Where do the initial ideas even come from? How do you find stocks to analyze in the first place?
Ideas can spark anywhere. General observation, Peter Lynch style. What shops are always busy? What brands do people love? Seeing PVR cinemas packed, noticing Cummins generators everywhere, using Naukri.com, these are real-world clues. Stock screeners. Use online tools to filter thousands of stocks based on criteria you set, like ROE 25%, PAT margin 20%. Narrows the field. Macro trends, big picture shifts. Government pushing infrastructure. Look at cement. Energy drinks taking off. Look at beverage makers. Special situations, company-specific events. Maybe a well-respected outsider joins the board, hinting at change. A colleague apparently made a 200% gain on Cox & Kings after Techie Mystery joined their board, that kind of trigger. And, importantly, your circle of competence. Leverage what you already know from your job or industry. A doctor understands hospitals better than a software engineer, and vice versa. Stick to what you understand.
And you build a watch list from these ideas, right? Keep track of interesting companies, even if they aren't buys right now.
Absolutely. A company might be great, but too expensive today. Put it on the watch list. Market conditions change, prices fluctuate. Revisit it periodically.
Once you have a candidate, you mentioned looking for a moat, Warren Buffett's term.
Yes, the moat is crucial for long-term success. It's the company's sustainable competitive advantage, what protects its profits from competitors over the long run. Eicher Motors' Royal Enfield brand is a classic example. That brand loyalty, that cult following. It's incredibly difficult for anyone else to replicate that. That's a strong moat.
Other examples?
Maybe Infosys's initial advantage in labor cost arbitrage. Page Industries' exclusive license for the Jockey brand in certain regions. A housing finance company focusing uniquely on affordable housing where big banks don't play. If we connect this back, the truly great long-term wealth creators nearly always have a durable moat.
Okay, so the actual due diligence process, you said 3 stages. Understanding the business first.
Stage 1. Understand the business. Deep dive. Read the annual reports. Visit the website. Maybe even try the product. Ask tons of questions. Who are the promoters? Background. Track record. What exactly do they sell? Where are the plants? Raw materials. Who are the customers? Competitors. New products coming. Regulations. Labor situation. Barriers to entry. Subsidiaries.
And look for red flags at this stage.
Yes. If you find major red flags here, shady management, a dying product, intense regulatory pressure, maybe stop the analysis right there.
Yeah.
No need to waste time analyzing financials if the fundamental business case is broken. This stage builds conviction. If you truly understand why you own a stock, you're less likely to panic sell during a market dip.
Okay, stage 1 clear. Then stage 2, application of the checklist.
Right. Now you take your financial checklist, those key ratios and metrics we discussed, and apply it rigorously to the company, comparing its performance against your understanding of the business.
Let's run ARBL through that 8-point checklist you mentioned earlier. How did it stack up?
Okay, quickly for ARBL, based on that older data. 1, revenue and PAT growth. Yes, healthy double-digit SIGGRs. Check. 2, EPS growth, consistent with PAT, no major dilution. Check. 3, gross profit margin, strong, over 20%, around 28%. Check. 4, debt level, low and managed well. Check. 5, inventory management, stable inventory days growing with Patry. Good sign. Check. 6, sales versus receivables. Sales growth not funded by ballooning receivables. Encouraging. Check. 7. Cash flow from operations. Consistently positive. Core business generating cash. Check. 8. Return on equity. Excellent. Over 20%, around 27%, and not juiced by excessive debt. Check.
So it passed with flying colors on that checklist, meaning it had those investable grade attributes.
Based on that analysis, yes. The business story and the financial numbers aligned well. It qualified as potentially investable grade.
But finding a great company isn't enough, is it? You need to buy it at the right price. Stage 3?
Exactly. Stage 3 is estimating fair value. After all that work identifying a great business, you need to ensure you don't overpay. This is where we try to estimate the stock's intrinsic value, its true underlying worth based on its future potential. The most common method for this is the discounted cash flow DCF model.
Okay, discounted cash flow. How do we even begin to estimate that right price? You mentioned net present value, NPV.
Yes, NPV is the core concept behind DCF. Let's revisit Vishal's pizza machine. It's projected to generate $500,000 in cash each year for the next 10 years. The question is, what is that future stream of cash worth today?
Because money today is worth more than money tomorrow.
Precisely. That's the time value of money, TMV. A rupee or dollar today can be invested and earn a return, so it's worth more than the same amount received a year from now. Compounding tells us the future value of money invested today. Discounting does the reverse. It tells us the present value of money to be received in the future.
Can you give a simple example?
Sure. If you could invest at 8.5% a year, $5,000 today would grow to about $7,518 in 5 years. That's compounding. Conversely, if someone promises you $10,000 in 6 years and your opportunity cost, what you could earn elsewhere, is 8.5%, the present value of that future $10,000 is only about $6,130 today. That's discounting.
Okay, so back to the pizza machine generating $500K a year for 10 years.
You discount each of those future $500K payments back to its present value using an appropriate discount rate, like our 8.5%. You calculate the present value for year 1's cash flow, year 2's, year 3's, all the way to year 10. Then you sum up all those individual present values. That total sum is the net present value, NPV. In our example, it was roughly $3.28 million. That's theoretically the maximum George should pay for the machine today. Ideally, he pays less for a margin of safety.
Right, so how do we apply this from a pizza machine to a complex company like ARBL? Can we just swap the machine for the stock?
Essentially, yes. Instead of the machine's simple cash earnings, we use the company's projected free cash flow, FCF. FCF is the cash generated by the company's operations after deducting the capital expenditures, CapEx, needed to maintain and grow the business, like buying new machines, upgrading factories.
So it's the cash left over for all investors, debt and equity holders after the business has reinvested in itself.
Exactly. It's a truly discretionary cash flow. The ability to consistently generate strong FCF is a hallmark of a really healthy, valuable business.
And we can calculate past FCF from the cash flow statement.
Yep. You take cash flow from operating activities, CFO, and subtract capital expenditures, usually found within the investing activities section. That gives you the historical FCF. For ARBL, their historical FCF likely varied, maybe even negative in FY14 if CapEx was very high that year due to expansion. But typically, you'd want to see a history of positive FCF. Those historical FCF numbers then become the basis for forecasting future FCF, which you then discount back to the present using the DCF model, just like we did with the pizza machine, to arrive at an estimated intrinsic value for the stock.
Wow. Okay, we've covered a massive amount of ground there, from identifying a business, understanding its quality, analyzing its financials with ratios, and finally estimating its value. You've really just completed a comprehensive deep dive into fundamental analysis, going way beyond just headlines, learning to assess a company from the inside out. You genuinely now have the core tools to do this.
It's a powerful framework. But remember, while we've learned how to spot a great business and estimate its worth, the real differentiator for successful investors often comes down to something else. It's the patience, the discipline to hold on to these fundamentally strong companies, even when the market gets choppy and noisy in the short term. It's truly understanding that time is the investor's ultimate advantage, allowing that compounding magic to unfold. So maybe the important question left for you is, how will you use this knowledge now? How will you refine your own approach to leverage that luxury of time the market offers?
A great question to ponder. So go out there, get curious, start your own deep dives into companies that interest you. Until next time on The Deep Dive, keep learning and definitely keep asking those big questions.